8 years and almost 200% return later, we take a look at my pension plan portfolio. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. I am with my co-host Véronique as usual. How are you doing, Vero, today?
Good, Mike, but it's raining outside and I still have kids at home. Last time.
Last time we were recording with kids. That's good.
I can't wait for school to be back, to be honest. But anyway, it's the same thing every year, right?
Yeah, but funny thing is, like, now it's like starting gradually the week before we're recording. So we're recording this at the end of August, and I already noticed more people on the roads, a little bit more traffic around. Right. And even when I run, I always wave at everyone, right? So like during summer at like 6 a.m., I may wave to like 3 people. And right now I'm like at a dozen. So I'm like, okay, what's going on, guys? Like, go back to sleep. Like, what's happening? So yeah, we can see that everyone is getting back to, I don't know, reality, if we could say that way.
Yeah,
so summer's over, no more vacation, go back to work.
And talking about work, Mike, you review your portfolio monthly and share it on the Dividend Guy blog. But we thought of doing a quarterly update here on the podcast so that we can use it as an example of portfolio management. So this time, we will discuss some of your losers, including Apple, and see if you should keep it or sell it.
Kind of crazy. Never thought we would make an episode on being down on Apple. Of course, I'm not down since I purchased those stocks, but still, bad year for Apple, bad year for a few other companies in my portfolio. So it's going to be interesting. And while you have like the full report on the Dividend Guy blog, it's more about the numbers and stuff. So today we're going to tackle a little bit more the thinking and the management side that is a little bit longer to write, but more suitable for a podcast, actually. So keep that in mind. I'm in for the long term, but I still monitor my portfolio quarterly by looking at earnings. And this is key to make good decisions. Because if you're just like looking at, oh, I'm down like 20% on Apple, I should sell. Well, that's not enough. And this is what we're going to talk about today.
So first, Mike, remind us of how this portfolio was created.
So in 2016, I took a sabbatical year, traveled around Central America with my family in a small RV. I had a lot of fun. And then when I came back, I'm like, you know what? I'm done with the banking job and I'm going to work full-time at Dividend Stocks Rocks. So when I did that, the National Bank offered me two options. Either I keep my pension plan with them and I have a very small pension payment whenever I retire, which was quite ridiculous, to be honest. Or I can have a check of $108,000, which seemed a little bit more appealing, especially when I run the calculation, because it's always a case by case. I realized that to create a safe pension, as they were offering me at the age of 65, I needed to generate about a 3% total return, annualized return, per year. So I thought, well, I think I can beat that. It's not too hard if I go like all in on the market to beat 3% annualized growth rate. So I took the pension plan, and that's invested in a locked-in account. That means I cannot add capital. So I had the $108,000. If I lose that money, game over. I cannot add any capital. I cannot withdraw it right now because I'm not retired. So it's only about capital gain and dividend that are reinvested. So I started investing in September of 2017. It took me about 3 months to fully invest the entire amount because I was building Dividend Stocks Rock at the same time. But after a month, like at the end of October, I was already 75-80% invested. The goal was to have 50% of my portfolio in Canadian stocks and the other 50 in US stocks to have a better diversification. And I've been able to maintain this allocation so far. So currently, as of today, I'm like 56 US, 44 Canadian, just because the US market is still a little bit outperforming over time. So whenever I have a chance, I trim a little bit, but the overweight is always present, but it's not the end of the world either.
So we have made a market overview of the year so far. Last week, while we were discussing an upcoming recession, you can listen to that, listeners, at thedividendguyblog.com/241. But how would you summarize the latest quarter for your portfolio?
Yeah, it's ironic this year because we were expecting so much of a bad year. Like the Canadian economy should be destroyed by now. And it's completely the opposite. It was actually a pretty good quarter. And most companies in my portfolio are reporting pretty good numbers as well on their quarterly or so far this year. So we have like 2 quarters in, some 3 quarters in, and then just like doing business as usual. Kind of crazy. So I even wrote not too long ago in an update that Trump is winning so far. And by that, yeah, don't laugh. By that, I mean, he made a play on increasing tariffs, thinking that it's going to make everybody in the US better, the economy, the job, everything's going to be perfect. I don't believe that. But so far, the market is responding well. The economic data is not too bad, but I added so far because there is a huge lagging impact on those decisions. First, they have changed like freaking, I don't know, 52 times. So a lot of like companies ordered a little bit more materials, consumers like push, and we're going to talk about Apple today, but they bought more iPhones right now thinking, oh, the next iPhone that I will buy in next year may cost me like $2,500 or $3,000 if the tariffs are come in place. So I might as well just pay it right now. It's going to be cheaper. So you have those data that are kind of like twisted a little bit because a lot of like orders that went in that should have not happened at this point. So probably that in the second half of 25, I mean, not the second half, but the end of 25 and probably we enter in 26, we're going to see like worse numbers. This is why we're talking about the recession last week. So I still think it could happen. But the portfolio so far, I was super happy about the results. So that's good news. I mean, again, kind of crazy, but I'm still trading at an all-time high, around $318,000 right now. And keep in mind, I started at 108, so almost 200% return since I started this portfolio 8 years ago, sorry. So quite happy about the results, of course, but always keeping this in mind. The market fluctuates, so I would not be surprised if this portfolio goes from 318 to like 275 within the next 6 months or next year. It's always a possibility. So I'm not here to brag. I'm here to help you see how I manage the portfolio the best as I can.
All right, so you have losers this year, and among them we find Apple, Alimentation Couche-Tard, and Starbucks. So let's start with Couche-Tard, which I hold to, and I have seen many analysts grading it down lately, Mike. So what's your view on it?
Yeah, so we're already done with the fun part. Is that it? All right, Couche-Tard. So they face a lot of issues. It has been a good 2 bad years, actually. Yeah, it's about 2 years now. So revenues are slowing down, mostly driven by a weaker economy. When you think about like consumers probably not buying as many snacks or beers or cigarettes in convenience stores. So that is slowing down a little bit. The economy is not rolling 100%. So you have like less transportation. So if you have less transportation, you have less need for fuel, and less need for fuel, less stops, less consumption. So it's tough on margin too, obviously. And for the past, I think it's a year now. Yeah, it was like August that started this whole thing. So for almost 12 months, we had this adventure of trying to acquire 7-Eleven. Back and forth, chatters, rumors. Yes, we're going to like make it happen. They don't want to make it happen. Anyways, they dropped the deal not too long ago during this summer. And that is one thing that I love about Couche-Tard, because so many analysts just said, oh, yeah, well, if they do that, they're going to raise way too much debt. They're going to issue way too much shares, going to dilute the value of the company, and it's going to be a bad deal. Couche-Tard doesn't make a bad deal. They either make a good deal or they walk away. And in this case, it was clear that the whole situation was not going to end up into a good deal. So they just dropped the ball and just say, you know what? We're going to move away. We're going to do something else. And when that news happened, the stock price gained a few percentage points, which was good, but didn't last that much. So the overall narrative is still negative around Couche-Tard. And that's the thing. They do have a plan. But right now, the results are not like they're not showing, they're not there.
Mhm.
So you're going to have like one quarter, it's not that bad. The following quarter, it's still shaky. And it's been ongoing for the past 2 years. So a lot of analysts are just like, yeah, well, unless they show us a clear path to growth, we're just going to ignore Couche-Tard or downgraded it as you mentioned. So that's what's happening right now. The narrative is not that great, and the numbers are actually following that relatively negative narrative around it.
Mike, I'm adding a question here. Couche-Tard is known to grow by acquisitions. So are they becoming too big to make great acquisitions? Like, is that an issue here?
That's a very good question. I don't think so. I mean, of course, it's a little bit more challenging. Even with 7-Eleven, they had to work a lot on figuring out how to get this approved and sell a lot of convenience stores, especially in the US, to not fall into antitrust laws and stuff. But I mean, not too long ago, I think it was like 3 years ago, they bought over 2,000 convenience stores and gas stations from Total Energies in Europe. So there's still a lot of room to grow, but they have to be a little bit more careful. Of course, it's nothing close to the size of buying 7-Eleven. That would have been a transformational acquisition, but there's still a lot of like smaller candidates that Couche-Tard could go after. I mean, they tried to buy KC Stores several years ago, didn't end up very well. And I wish they had it because right now KC Stores is doing very well.
Mm-hmm.
So you never know what could happen, but there's still room for growth for acquisition. But even management knows that at one point it's not necessarily going to be the main driver. And in the current plan they have, 40% of the growth is supposed to come from acquisition. The other 60 is aimed at growing organically. So like improving the product offering, especially going towards fresh food and like meals that are already packaged for consumers. This is more the avenue that they want to take, knowing that it's not always easy to buy 2,000, 5,000 stores at this point. But they do have the balance sheet to do it. So that's not the issue.
Okay, so how much weight does it represent in your portfolio? And are you considering like maybe trimming it down a bit or maybe buying more?
So one thing that's interesting that you cannot see on the Dividend Guy blog when I report it, because I just report the pension plan, is when I look at my portfolio, I look at all my portfolios together as a whole because they all have the same goals. So of course, I'm not going to integrate my RESP for my children in this. I'm just going to look at all portfolios that will help sustain my retirement. So when I combine all of them together, I will show 6% of all my assets invested in Couche-Tard, which is my third largest position behind Microsoft and Apple. So over the years, I've trimmed a few times my shares of Couche-Tard. So my rule is quite simple: never exceed 10%. And it happened in the past. So every time I just sold about 2%, going back to 8. And right now the thing is, yeah, it hasn't been like 2 good years for Couche-Tard, but it's not like it's going down like 50%. It's more that the rest of the portfolio is growing fast and this part of the portfolio is lagging at the same time. So that explains why it went from like that classic 8% position to a 6. Especially Microsoft has been like just growing like there's no tomorrow. So the rest of the portfolio is going well. So it kind of like naturally bring the position of Couche-Tard a little bit lower, which is a good thing because it helps me keeping a good diversification without doing anything. So that's great. So I don't have any intention of trimming at this point, and I don't have any intention of growing my position. 6% is already more than a full position in my portfolio. Ideally, I try to keep it around like 3 to 3.5, but I let my winners run. So this is how Couche-Tard ended up being 6% of the portfolio. So I'm willing to wait another full year without taking any decision at this point. It's not a catastrophe. It's just a pause. It happened in the past for Couche-Tard several times in its history. So that's why also I'm not that worried at this point.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. You know, our goal is to help more investors just like you, so please spread the love. Thank you.
All right, so let's move to Starbucks, which failed investors in its latest quarterly earnings with EPS down 46%. What's
That's
the
not a good
cause?
number.
No. What's the cause of the lower profit for this like big coffee company?
Yeah, so to make it clear for Starbucks this year to date, it's about flat, maybe up 1%, maybe down 1%, depending on when you look at it. So it's not a big loser, but it has been a challenging 2 years again. As you
Mhm.
mentioned, earnings are free falling, like there's no tomorrow, which is, of course, concerning. We're used to see Starbucks showing high single digit to double digit growth for both revenue, same store sales, and earnings, which is definitely not the case right now.
Mhm.
The company is facing a lot of challenges. So of course, we growth on both in China and in the US. One of the problem here is, well, of course, with the inflation of the past few years, consumers, their budget are a little bit tight at this point, and going to Starbucks, spending $8 for a coffee, not exactly the best way to get back on track financially. So there is that. In China, they face lots of competition. It's a crazy story. Several years ago, Luckin Coffee was, of course, a coffee shop from China. It was growing very fast and then ended up into a lot of problems because they were
Mhm.
falsifying their accounting statements. The company almost went nowhere, and then they brought it back, and now it's still running full steam ahead and gaining market share in China. So it's kind of ironic because Starbucks developed the market, convinced Chinese to drink coffee, and now another company is taking over there. They have the intention to come in the US. They opened, I think, 2 stores in New York City right now. But clearly, they're not just opening 2 stores to have fun. They probably want to enter that market. So that hurts too. The raise of having union in the coffee shops and Starbucks hurt the margin, create a lot of distraction. It's also a symptom of like other problems. It's getting more complicated to do that caramel macchiato, double shots of espresso, 1 shot of caramel, a non-fat latte, and then I would like to have like, I don't know, my name written in the foam and like all those kind of like strange stuff that you may want. I mean, it's great because you can have like a customized drink, but that takes forever to make,
Mhm.
and that increase the waiting time. So it will discourage both the barista and the consumer. So a lot of things are happening at this point. And that's why right now earnings are down. They have to spend a lot of money into restructuring the business, closing stores, and finding new ways to get on their path to growth, actually.
Mhm. So, Mike, even though, like you've said, it is not a big loser this year, it still lags the market and has been struggling for a few quarters now. So, are you considering letting it go?
Not yet. I usually, when the narrative versus the metrics, this is how I like to look at all
Mhm.
my stocks. What I do is I look at the investment thesis, which is all the reason why I bought a stock. And then I look at the dividend triangle, so the trend for the revenue, the earnings, and the dividend. So in the case of Starbucks, besides the dividend, nothing is really growing. So again, the metrics is telling me, they are telling me that I'm right now wrong with my investment thesis. But
Mhm.
of course, you're going to run into hurdles for any businesses. It's never perfect all the time. And then right now they have a new plan in place. They have a new CEO. So there's a lot of hope. Now, again, it's similar story than Couche-Tard. It's a matter of seeing this narrative being transformed into numbers. But for that, you need time. So if I'm trigger happy, I've already sold Couche-Tard and I already sold Starbucks. But you have to be patient when you invest. And I'm not investing for the next quarter. I'm investing for the next 40 years of my life. So I'm willing to wait 2, 3 years of
Mhm.
having bad metrics. They are going against my investment thesis. But of course, if it continued to plummet, maybe I'm going to review that like shorter to 2 years instead of three. But at this point, I'm not concerned. I like what they're trying to do with their new plan and their new CEO, and I'm willing to wait another year before taking a decision. So of course, I'm not going to say, hey, Starbucks is the most amazing company in my portfolio. It's not, but I can live with that at this point. And of course, that's the luxury of having a well diversified portfolio. So while some of those stocks are not doing well, I have others that are performing. So it helps to swallow the pill a little bit more.
But Mike, adding another question here
There you
again.
go.
We have welcomed Ryan Williams like earlier this year on the podcast, and like you share similar views about the stock market, and he was also a big fan of Starbucks, but I saw that he sold his position.
Mhm.
So what would be a good reason to sell it right now? Like, what would explain investors moving away from it?
See, this is why it's so exciting to have that stock market because perceptions could be completely different. And I'm going to also add whenever you're selling, somebody else on the other side is buying. So when you think it's over for a company, somebody else is actually thinking about the exact opposite of your thesis. So for Ryan, one of his major point, and I have to agree with him at this point is, yeah, new plan, new CEO, lots of hope, no results. And this is what he was saying. I mean, on the earnings calls, you listen to that. And of course, the CEO's job is to convince you that they're moving forward. Like for all companies, they're rarely going to say, you know what, guys, it's terrible. It's going down. And we're not going to grow for the next 5 years. No CEO are going to say that. I mean, even Bell's CEO was optimistic when they announced the slash of the dividend. They're always trying to put a better twist on that, right? They usually use those like financial flexibility, better balance sheet, more cash flow. Well, long story short, they failed investors and they slashed the dividend, but this is not what they will offer. So Ryan's position is completely valid. He's just like, I'm done waiting. I wanted to see impact on numbers. They're not happening. So they may have like a whole bunch of cheerleaders of Starbucks telling me that it's going to happen. I'm just going to move out and move on and buy something else. And this is what creates a lot of dilemmas for investors. Because I mean, you're listening to me, I'm saying I'm keeping my shares and I'm not worried. And then you're listening to Ryan and he has other very good point, very strong argument for selling. So who's right? I mean, we're going to know in 5 years. So there's no debate at this point. What is more important is to have rules. So on my side, my rule is like 2 to 3 years of waiting for a company to turn around. And I've learned that because I once was a little bit more trigger happy and I got rid of my shares of McDonald's for that reason. We did an episode on that a while ago, like some companies that I sold and I regret. And back then they were going nowhere and I should have kept those shares. I probably waited maybe like a few quarters, maybe a year top. So that was definitely not enough for a large company like McDonald's to turn around and find solutions. So I decided to be more patient. Most of the time it pays off. Sometimes it doesn't, but that's the name of the game. The point is to get rid of that dilemma instead. So I'm not trying to figure out if Starbucks is going to make it or not every single day or every single quarter. I just say, you know what? They're on a path. They make sense. Let's review that next year. And unless there's a big catastrophe, I'm, of course, monitoring a little. I give a little more attention throughout my quarterly review to a company like Starbucks or Alimentation Couche-Tard that are down my portfolio versus another one that is going amazing. But yet it's not about having doubts. It's more about having all the facts together so I can take a better decision down the road.
And you know what, listeners, I did that on purpose because I wanted Mike to say that the important thing is to have rules and to have a process, not like
you tricked me.
But
in a good way.
That's the whole point of doing this quarterly review of your portfolio. It's to give people management tips and not necessarily only opinions and thoughts.
Yeah, there you go.
So now the big question, Apple, it used to push your portfolio to new highs, but that time seems to be over. So what's going on with it?
Yeah, what's going on with Apple? I mean, I trimmed this one so many times I can't even remember, and yet it is still 8.6% of my portfolio, my largest position. But here's the thing. Apple goes through innovation cycles all the time, which means they spend a lot of money in R&D, they come up with a new innovation, improvement on their iPhone, Apple services a few years ago that has become an amazing business within the business. But in the meantime, nothing happens. And when nothing happens, a lot of investors starts to get concerned. And ironically, I bought my first shares of Apple in 2014. So it's been 11 years now. And every single year, you read dozens of papers telling you that Apple's going to die or it's over, the growth is done. So I'm not saying that they're always wrong, but I just want to highlight that this innovation cycles that we're in is just normal. Right. The other layer of problems, though, that is a little bit more concerning is right now they're clearly missing the AI boat. So they're behind with artificial intelligence and they are playing catch up. One thing that I appreciate from Apple, though, is they are rarely the first player in a new field. We can think of the Apple Watch, which is like a very good example example, even the iPhone back then. I mean, BlackBerry dominated the market for a long time and then they just came in. So they have this habit to come with a product at a later date, but they have the cash flow, the reputation, and the balance sheet to sustain this. And then when they come with something, it's really strong. However, being late on something that has so much promises as AI could end up to be like a very bad move as well. I mean, it doesn't always pay back. I think of Intel, for example, that has been the gold standard in chips for decades. And then they started to miss one quarter, miss another quarter, and lag behind the development of new technology. I mean, to this day, they're just like falling apart at this point because the path to get back on track is, I mean, they're way behind. So there's one thing of like, you run a marathon and you're not in the top 10 right away, and it's okay because you have a good pace and you gather your energy. But if you keep on lagging and at one point you're like half an hour behind the leader, you're not going to finish first. That's not going to happen. And then you can run into another problem. And this is happening a little bit with Apple right now because they're in the middle of a rock and a hard place. They're between China and the US and that commercial tension and all the tariffs and the threats. So that is also adding another layer of concern. So that explains why Apple has been down this year. Now it's slightly on the rebound path, but it's still not positive year to date, just because they mentioned that they're going to invest more in the US. So trying to calm the market, trying to calm like the whole tariff threats around it. But we're not out of the woods at this point for sure.
So what do you intend to do with it? Like, should investors keep it or sell it?
So right now, the numbers aren't that bad. And again, it's kind of like confusing because they had a pretty good quarter this summer. iPhone sales like surged, but they surged because consumers thought, as I mentioned in the intro, maybe we're going to have to pay a lot more for iPhones like in a year or 2 years from now. So if I'm about to change it, I'm just going to rush this purchase. So is it going to be sustainable? I don't think so. But so far, the dividend triangle is actually good. I mean, it's not amazing, but it's good. As I mentioned also, they are in the middle of an innovation cycle. So it's kind of like normal. And this is kind of like encouraging because they're just following the same playbook as usual. They generate so much cash flow and they have such a strong balance sheet. They can afford to make mistakes or they can afford to take their time, especially because with their expertise and their history of coming with strong products. I'm not worried yet, but again, I'm going to follow my rules. I mean, at this point, the narrative and the investment thesis are still valid. It wouldn't surprise me if the dividend triangle seriously slows down maybe in a year from now, but at this point, I'll be in a better position to take a move. I may trim at this point if it happens, mostly because it's the largest position in my portfolio. So it's more thinking of like exposure to risk. If I sell 2% of Apple, it doesn't mean much because I would go from 8 to 6%. So it would still be among my top 5 largest position. And I would just take some profit off the table. So that would be more a move into portfolio management, but I'm definitely not there yet. At this point, I live very happy seeing Apple not performing this year. I never give value to short-term price performance ever because that is just market noise. So yeah, Apple is down. It was down 20% at one point this year before the rebound. I was still up more than 1,000% in my portfolio. So what's 20%? Nothing, right? So this is the way I can see it. And this is how I manage stocks in my portfolio as well.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers. And we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar.
All right, so now let's also talk about Granite REIT for a while, because it was among your losers for many years, and now the REIT is up more than 20% this year. How would you explain like this sudden turnaround and sudden love from the market?
I kept on buying and buying and buying and pumping the stock like there's no tomorrow. No. I mean, I always said that Granite is like one of the most frustrating holding in my portfolio because the stock price doesn't perform, but the company does. I mean, revenue is up every single quarter. Funds from operation is up every single quarter. FFO per unit is also up. And they keep increasing their distribution while maintaining like a relatively low FFO payout ratio. So everything is there. It's kind of crazy, but no love from the market. So what's happening right now? I don't know. I really don't know. And honestly, I don't mind because it only makes sense. If a company is able with consistency to report good quarters after good quarters and being ignored by the rest of the market, the problem is not the company. The problem is the market. So you don't have to worry about that. And the perfect example I can think of is during COVID, when the market dropped like by 35% within like 30 days and then came back very quickly. Well, the thing is, the market was just speaking panic. They were just like panicking, but the numbers were not necessarily like, yeah, some companies had like a lot of problems, but not all of them. Actually, some of them were actually thriving during those months, and yet their stock price dropped and then it come back just because the market realized, oh, wait, the numbers are actually good. What we thought is going to happen is not happening. So now we have to review. So my guess is this is what's happening with Granite right now is just, oh, okay, so this REIT has been around for a while. They keep on showing strong occupancy rate. They keep on showing good metrics. So might as well think about buying some shares at this point.
And which other stocks are bringing your portfolio value up this latest quarter?
So to prepare for this review, I pulled out my pro report. So using the platform, it's like super easy. Dividend Stocks Rock, you can build all your portfolios and then you can generate a report for each quarter. So then you have like the summary of everything that happened for each of your holdings in one page. So you have the CEO quote, you have the summary of what we think of the quarter, like our analysts at DSR, the ratings, the year-to-date returns, and the link to the press release if you want to dig further. By looking at it, I saw some good news across the board. So some of them, Stantec, keep on reporting solid quarter after solid quarter. I did an episode on that on the Moose on the Loose not too long ago. This one is up, I think, like 30% this year, doing amazing. And the funniest part is it's justified not by hype but by numbers. So double-digit growth. I mean, you want to buy that. Toromont Industries, which is also going very well. The numbers are okay, but there is a lot of hope about like construction and the investment infrastructure. So the stock price is going up as well. CCL reported like revenue and earnings growth of 9%. I like also when a company reports revenue and earnings about at the same pace. So it tells me that they're selling more, they maintain their margins, so they make the same profit. So I like when that happens because it's a little bit more consistency. Another company that did not get a lot of love as of late and is on fire this year is Brookfield Renewable. So similar to Granite, always reported good numbers, good growth, but lots of speculation, lots of volatility. We're going to take this one as a win so far. And I mean, National Bank, that was quite expensive at $100, so you should have waited and not buy it at $100. And then at 125, you should have waited as well so it could come back at 90. And then as of late, it trades around 150. So I guess overpriced once again. So just wait until it goes to $90. It's going to be better. But anyways, in the meantime, I'm going to be happy about it. I'm going to cash my dividends and I'm going to continue to be a number one National Bank cheerleader.
All right, so listeners, dividendstocksrock.com if you're interested in having your own quarterly report, DSR Pro reports. We're going to talk about valuation next week, by the way. So you might as well like hit pause and the subscribe button underneath our podcast logo not to miss it. Mike, we've been looking at your portfolio mainly from a stock price point of view today. Volatility can bring confusion to investors, and this is exactly what we will talk about in our upcoming webinar, right?
Yeah, I noticed that every single time I do a webinar, at the end we do a Q&A that lasts usually around an hour. So I have a lot of questions, a lot of fun, and most of those questions are around, Mike, what do you think about stock ABC? It's up 10%, it's down 15%. What should I do? What's going on? So there's a lot of what I call price confusion. Investors having a hard time understanding what's going on with the stock, especially short term. Why it's going up? Why it's going down? Should I sell? Should I buy? Should I hold? And this is what I want to do with this webinar. I'm going to walk you through my quarterly analysis process to make the difference between noise and news, because sometimes there are important news as well. So you have to make the difference between both, right? We're going to provide you with a framework to determine this. And then you're going to have this checklist of like how to analyze a business model, understanding a little bit better what to look inside a quarterly earnings from the company, not spending like 5 hours for every holdings you have, but actually being able to review it within like 15, 20 minutes and get the most important part out of it. Finally, we're going to end the webinar with the dividend triangle analysis. I'm going to show you how to analyze those trends and to see clearly to make the right buy and sell decision, and finally get rid of that paralysis by analysis.
So listeners, I now invite you to save your spot for the live session or to get the instant replay for free, thedividendguyblog.com/webinar. The event is scheduled on September 18th at 1 p.m. Eastern Time, but the replay will be sent to all registrants. And like Mike said, after the presentation, there will be a full hour Q&A session where it will be your turn to ask questions to Mike. And I'm going to not talk and be in the chat. So again, join us at thedividendguyblog.com/webinar. Mike, as we are entering the final quarter of 2025, are you starting to plan some transactions? What are your overall expectations for the rest of the year regarding your portfolio?
So I did a lot of transactions, well, not a lot, but a few transactions, a few tweaks last year as we were at the all-time high. And I always keep saying this, when you're out all-time high, review your portfolio. This is the perfect time to make those decisions, just to make sure that you're well covered, well diversified, and you do not have any blind spots. At this point, I'm all good, 100% invested, so super happy with the portfolio. I started a position in Dollarama earlier this year, and my main goal at this point is to build it to a full position, so at least 3% of all my assets. I'm definitely not there yet, so I'm going to use dividend payments across most of my portfolios to build that position to full, but that's pretty much what I have in mind in terms of transactions. So probably not going to make any other changes for another, I don't know, at least 9 months, maybe a year. So maybe we're going to revisit this in a year from now, and I will do maybe 1 or 2 transactions. I don't think it's a good idea to change your entire portfolio every 6 months or something like that. The key for success as an investor is to find a strategy that works for you and then to keep it. So if you keep on buying and selling stocks or ETFs all the time, well, you're changing strategies or modifying your strategies all the time. And therefore, it's like, I said it a few times because when I heard that analogy, I really like it. You know, your portfolio is like a bar of soap. The more you play with it, the less you will have. So sometimes you just want to like put it on the shelf and then forget about it. Most of the time, that's the best move an investor can do, is no trade. The good trade is the no trade.
Right. Well, thank you, Mike, for sharing your portfolio management tips with us. Listeners, remember to save your spot for our upcoming webinar to avoid price confusion at thedividendguyblog.com/webinar. For our show notes and related content, visit thedividendguyblog.com/243. Do not leave without hitting pause and the subscribe button underneath our podcast logo to avoid missing any episode. You might as well leave us a 5-star rating. Next week, as I said, we will discuss valuations. So until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.